Adrian van Tiggelen is Senior Investment Specialist with ING Investment Management. Thank you very much indeed for joining us. So, Adrian, the Bank of Japan seems to have set the tone, really, in their decision to cut their benchmark interest rate some 24 hours ago, and now expectations are mounting that other central banks will follow in their footsteps.
Yes, that's true, Maryam. What we see basically is that central banks are trying to put a floor under a struggling economy, a struggling Western economy, which remains fragile, certainly as far as consumer confidence is concerned. And we are now basically muddling through in the West, and that may continue for some while, well into 2011 or maybe longer. As on one side you see that central banks are trying to put a floor in by printing money and buying back bonds, basically. On the other side, you see also that companies, certainly in the US, are now buying back more stocks than issuing stocks, so that's also a source of liquidity. Both give support. On the other side, you see that there's not a high likelihood that the consumer will recover very soon. And if they would recover soon and fast, then you would also get the situation that a fast recovery would cause spikes in interest rates, which a highly indebted world cannot carry. So we are a bit in a muddling through scenario.
So from what you're saying, central banks are pumping more money into the economy. Many companies are sitting on a lot of cash right now. Yeah. You're saying these markets are driven by liquidity. Does this benefit bonds or equities?
Actually, both at the moment. The fact that investors are risk averse and that the outlook for inflation is very, very modest, more an outlook for disinflation, and the fact that central banks are buying back bonds, government bonds, still makes long bonds quite an attractive option, certainly in the core euro countries, we think. As George Soros was already referring to, the strategy of Germany will only probably drive German bond yields down further. So there's still something to say for bonds. On the other side, equities can also benefit to a certain extent from this liquidity creation which is taking place now.
And of course, the price of gold continuing to hit fresh highs.
No, that's a hedge against policy mistakes, basically. What we are walking a fine line right now between stimulus, what we see in the US, Japan, the UK, on one side. On the other side, we see the Germans and the ECB being more cautious. Nobody knows exactly what the outcome will be. Any policy mistake being made is good for gold, and that's why you see the gold price going up. It's of course going up in dollars, not so much in euros, because at the same time the dollar is declining.
And what about the risk of inflation? It's not, obviously it's not a risk right now, but in the event of further QE?
Yeah, we still see that as a risk which is certainly not imminent, very far out, if we'll see it indeed. We are of the opinion that QE will not lead to any inflation soon. Printing money is not inflationary, spending money is inflationary, and we think that consumers will remain very hesitant on the spending front. So we still are staunch believers in the fact that inflation will remain low for long. Into 2011 and even 2012, we are more afraid for disinflation, for very low inflation, than for high inflation.
Adrian van Tiggelen from ING Investment, thank you very much for joining us. Good to talk to you.
You're welcome.